Yeah. Cool. Hi everyone, how you doing? Another episode of the best real estate investing advice ever show via Facebook Live. If you have any questions, then feel free to post in the comments section below, and we will either get to them on this show right after we get done with the normal flow of it, or we'll address them on next week's episode. So you ready to go? You ready to start recording?
Let's do it.
All right. Best ever listeners, how you doing? Welcome to the best real estate investing advice ever show. I'm Joe Fairless. This is the world's longest running daily real estate investing podcast. We've spoken to Barbara Corcoran from Shark Tank, Robert Kiyosaki, the author of Rich Dad Poor Dad, a whole bunch of others. And today is Friday. I hope you're having a best ever Friday, and we're going to do Follow Along Friday. I am with Theo Hicks. Theo, how you doing?
Doing good, Joe. How are you doing?
I'm doing well. Nice to partner up with you again and dive into it. So Follow Along Friday, in case you're listening for the first time, it is what we got going on in our entrepreneurial endeavors. We got a whole lot going on, that's for sure. And it's not to talk about what we're doing, it's to talk about the lessons that we're learning along the way so that we can apply it to what you're doing. And I think that's going to be, that is the most important thing out of this. So how do you want to approach today's conversation?
I say we start with the pizza party.
Pizza party. Yes.
Explain that.
Pizza party. Everyone loves a pizza party, right? I was interviewing Marco Santorelli, and his episode will air way down the line because we're booked, I think, 60 days or so out. So whenever I actually do an episode and I record it, we have guests who are booked, or I've already recorded 60 days out. So anyway, his episode will air later, so you're getting a sneak peek right now. And he was talking about an experience he had where a property manager essentially stole $6,000 in rent checks from him. And he said how you really make money on the operations, and I agree. I mean, we have to buy it right, we have to have the right business plan, but ultimately if the business plan isn't executed according to how our spreadsheet says it should be executed, then everything falls flat. And it's like the Mike Tyson quote, everyone has a plan until they get punched in the face, right? Same thing. And as I was talking to him, I normally don't multitask during interviews, but I also am wired to take immediate action if I have an idea. And I'll either write it down or I'll do something towards executing on whatever the idea is. And while he was talking and he said that, I was like, you know what, I have a phenomenal property management company for my single family homes and multifamily, but for whatever reason, single families came to my mind immediately. I said, I'm going to do a pizza party for the property management company. And I made a note of that. And then after the interview, I sent an email to the property management lead, and it's Emerald Property Management. There are two Emerald Property Management companies in Dallas. One's got bad reviews. This one has good reviews. This one is in Colleyville. So the good one that I use, single family homes in Dallas-Fort Worth, Colleyville specifically, is Emerald Property Management. I sent the email to the gentleman, his name is Ford, F-O-R-D, and I said, I'd like to throw you all a pizza party. He's like, what? Not totally, you don't need to. I said, whatever, I am. And I copied my assistant, and she's coordinating the details. And the pizza party's probably going to be $100. Well, they are managing my three houses, and I don't have to do anything with those houses ever because they've got it down. They have the houses filled. They address the maintenance needs. We retain the residents. They're really good about late fees and charging them if the resident is late. They're by the book, and that to me is incredibly valuable because my time and your time and everyone's time is the most important resource that we have. So from a business standpoint, I definitely see the ROI on a $100 pizza party because no one else does it. Most people don't do it. And it makes me stand out, so I guarantee that my properties will get a higher degree of attention than someone else's properties would. That's just human nature. That's the case. Even if they deny it, it's got to be the case. And even if my properties don't get a higher degree of attention, which they will, it made me feel good doing it, and it makes them feel good when they receive pizza. So it's a $100 investment, but guaranteed it will have 10 times return on that investment. Whether it is they find a more resourceful way to get a vendor to negotiate their price down, and that will pay back itself, or they find a resident faster, or they do a little bit of more work on tenant retention. So that was the pizza party idea. I just happened to talk to Theo about it earlier today, and he said, we got to mention this on Follow Along Friday, and so there you go.
Yeah, is the idea to do it as like a one-off thing, or do you plan on doing it frequently, or?
Don't do it frequently, because the best gifts are the ones that are unexpected.
Okay, yeah.
With certain exceptions, I send flowers to my 101-year-old grandma and my 94-year-old great aunt every month, and that's because they're lonely and they deserve it. They deserve the flowers, and that's something that they look forward to. But most of the time, the unexpected gifts are the best. That's why I believe it's much better to send people gifts around times that they're not expecting it versus the holidays. I don't send out holiday cards, but we send out signed copies of our book to my investors, my private investors. They end up receiving them on some random Tuesday of a month, and they don't expect that, and that's something that goes a long way. I got a lot of emails back from investors saying, hey, thanks a lot for sending me a signed copy of your book, appreciate it. And that stands out a lot more than sending a holiday card when everyone else is sending holiday cards, and your holiday card probably isn't that much different. And one quote that stands out to me in this is Tim Ferriss says, be unique before trying to be incrementally better. Be unique before trying to be incrementally better, because if we're unique and we stand out, we're much more likely to get more deals, get more business, get more leads, whatever, than if we're trying to simply be incrementally better doing what everyone else is doing.
Yeah, something else that comes to mind too, I mean, you've interviewed so many people that I'm sure you've heard of a ton of different unique ways. The pizza party, you sent out a book. Something else that comes to mind now is I know someone said, I can't remember who it was, but instead of sending out, like you said, like just like a holiday card, they'll send out a custom stationery that'll have like their name on the top. So like whenever they're writing your notes, like you're constantly seeing that person's name. So whenever you associate that with whatever kind of investor they are. And so if something comes up where they need an investor, or they want to invest in a deal, or if it's an agent, they find a deal, they're constantly flipping through the stationery pad and seeing your name constantly. It's your top of mind. So I feel like they all kind of fall into the same category.
Yeah, I agree. It has staying power. The stationery has staying power. A book has staying power, because when we send that book out and it's signed, we're infiltrating someone's house with our names, and now assuming that they don't immediately throw it away, which they might do, that's possible. But if they don't throw it away, then at minimum they're going to put it away on the bookshelf. And it's still there with their other books, and when they're flipping through books, they'll see it. But best case scenario is they read it, and it's right in front of them for a decent period of time. So the stationary thing is the same thing. It has staying power.
All right, let's transition over to the other topic, which is, I guess, maybe the meat of the podcast, which is tax benefits. I think yesterday was tax day. And so I was just thinking it'd be good to explain what the potential tax benefits are of either your investors or or from your perspective as a sponsor or a syndicator.
It's the same benefit, and I don't know about if this is going to be in the meat of the podcast because it's a pretty simple, pretty short answer. Pretty short answer. The benefit is really simple. It's depreciation. The depreciation of the property and the pass-through of that depreciation. Mm-hmm. So commercial properties depreciate a certain period, certain amount over time. I think it's 27 and a half years, I believe. And therefore, we're able to depreciate the value of the property, value divided by, if it's 27 and a half, which I think it is, that's how much money you can depreciate on paper, and that gets passed through to myself and the investors. Therefore, when we receive our K1s or returns, investors receive K1s at the end of the year, it shows a loss on paper, even though in reality they have received money, the quarterly or in some cases monthly distributions from the property. And that's amazing to high net worth individuals because it lowers their taxable income for the year, and it lowers the amount of money that they have to pay for taxes. Now the catch is, there's always a catch, right? The catch is when we sell a property, that money is recaptured by the government. So you have one of two options. Mm-hmm. You either have to pay the taxes on the final distributions that you receive from the property, or you can 1031 into another deal. And that's we will always seek out another deal to have to 1031 into. We don't promise investors that we will have something, but our intention is to be able to have an opportunity to 1031. That way there's not a taxable event for investors or ourselves, because we invest alongside investors. Therefore, we are limited partners. We have limited partner dollars, just like they have limited partner dollars. So we have alignment of interest there.
Mm-hmm. Yeah, if you do the 1031, I know that we talked about this last week when we were talking about preparing for an investor call and how one of your main focuses is on capital preservation. And I think it was Frank Zaccanelli who was also talking about that and saying how his mentor, I think it was Ross Perot, always said how investing is all about getting your capital back first. And so I was kind of just thinking about when you're saying that. So if the investor gets all their capital back in that first deal, and they 1031 it, and they had to move that capital to the next deal, then it's like infinite return at that point. Mm-hmm. So that's an interesting way to invest. That's a smart way to invest.
Yeah.
I can't think of any other tax questions. I don't want to I know you're not a tax attorney.
And we've interviewed a lot of attorneys or tax experts, CPAs, who have talked about this. And if you want to dig deeper in this, then Best Ever listeners, you can go to bestevershow.com and search tax or depreciation or 1031, and the episodes that have that in there will come up. And we mentioned this like a couple weeks ago. We have a transcription of every episode starting like 2 weeks ago. Yeah. So it's not retroactive, but for the last 20 or so days, plus or minus, and then moving forward, there's a transcription of every single episode at bestevershow.com. So it will allow you to easily search for things that perhaps you heard on a previous episode, but you don't remember when the episode is. And you can just search in the little search tool at bestevershow.com. That also helps me because we receive emails. I heard you on an episode about 3 months ago, and you said something about a house. Do you remember what that was? I was like, no. My assistant's like, do you know? I was like, I have no clue. Now they can search at bestevershow.com and try and find it.
Especially since it wasn't 3 months ago. It was like 6 months ago. There's just no way you're going to remember.
Yeah, exactly.
All right, so we've got 2 questions from listeners. One is from Brooks, and this was based off of last week's Fall on Friday, where we were talking about how to prepare and structure your investor call. And he was asking, at what point do you talk about money/splits in it for the investors? So when do you talk about the money and the splits with the investors?
Well, it's a pretty important component to the deal, knowing that the investors know what the structure is. Therefore, we have it on our summary page right after the table of contents.
Mm-hmm.
It's the investor summary, and it says 8 per whatever it is. In all cases so far, it's been an 8% preferred return, and then there's been a split after that. Usually it's 70-30. Sometimes we have a 70-30 split, and until we reach 18% internal rate of return to investors, and then 50-50 thereafter, or sometimes it's 15% internal rate of return, and then 65-35 at 18%, and then 50-50 after that. The project dictates the performance hurdles, but his question was, when do you communicate that? And the answer is when you talk to them about the deal for the first time.
Mm-hmm. And then just for clarification, the 70-30 split is when, after it hits 8%, then anything on top of that. So if it's 10%, then that 2% would be 70% to the investors and 30% to the sponsors.
That's correct.
Okay. The other question, so I think we addressed that one pretty well. The other question is similar, and it's from Kane. And he says, Joe, I'd love to learn more about how to structure equity partners in regards to paying their returns. If you have a podcast or episode or blog post to point me toward, that'd be great. And he says that he currently owns a duplex and a 12 unit and has his sights set on a larger syndication deal this year. I'm looking forward to learning. Thank you.
Cool. Well, congrats on the 12 unit and the duplex. What's the question?
The question is how to structure equity partners in regards to paying their returns.
Okay, well, I think I just answered it.
Yeah.
Right? 8%. Okay, let me back up. The structure depends on what your business objectives are, what the investor's business objectives are, and what the project can do. You need to look at those three things. I'm throwing out my structure just to give you an example, but it doesn't really matter what my structure is because it matters what fits your needs, your investor needs, and what the project makes sense. For example, development deals tend to have a higher preferred return because, say, 12% instead of 8%, because they're not getting paid anything for the first 24, 36 months,
mm-hmm. and
that money is accruing until it's stabilized, leased up, and it can start cash flowing. Other development deals I've seen are like a 4 or 5% preferred return, otherwise known as a pref, and it's 50-50, just a straight split after that. It depends on how you want to do it. You can also structure it where, and this is how you make the most money. I don't do it, but this is how you can make the most as a syndicator. You structure your investors so that they are exited out at a refinance. They get paid a fixed percentage, say 10-11%, and then so basically it's debt financing, debt equity. It's debt investors. They pay 10. You pay 10, 12, whatever percent, and then when you do a refinance, you pay them their 10, 12%, pay them back their money, and then that's it. Then they exit, and you maintain all the equity for the deal, and you hold on to it long term. You talk about how to build a real estate empire relatively quickly. You bring only debt-based investors for the first couple years while you're repositioning the property, and then you exit them out, you hold on to it long term, and holy cow, you could raise, say, $6 million by a $20 million apartment community, increase the value to $25, $30, $40 million, well, probably more realistically, say $30 million, and then exit them out, and now you've got a $30 million apartment community that you only own.
Yeah.
So it depends on those three things I mentioned before. That's how you structure it. What makes the most sense? I can tell you, industry standard is to have a preferred return and then some sort of equity split above that, like we do. However, you might have investors who only want to put their money in for 2 years. And if so, then that could be more of a debt-based raise versus equity-based raise.
So you do equity raise?
Yeah.
Okay. And last week we did
only bring on debt investors. It's more challenging because investors usually want the upside that real estate has, and that's why I do that with our investors. Up until this point I have. But if I come across an investor who's got 6-7 million and they're wanting 10-12% return and be exited out in 2 years, I'll say hallelujah.
Yeah.
Because then we'll go buy something, with the majority of their equity, we'll put our own money in it too, exit them out, and then we'll just own the thing ourselves for forever until we 1031 to something else and keep on growing larger.
Awesome. So those are the two questions we had. Is there anything else we got going on in the business?
We've got we got one. Yes, the short answer is yes. One deal we have pretty much closed the equity raise on, and then another that we should be getting under contract in the next day or two. It's an off-market deal, so excited about both those. And as you know, we just did our quarterly or our monthly email to all of our investors on all 8 properties. Actually 6 properties, 2 of them were just closed, so we didn't do a monthly email. And that went well. We send quarterly financials to the investors, and now it's just a matter of making sure properties perform and then seeing where these next acquisitions, just continue to do due diligence on these next acquisitions. We should get back an appraisal in the next week or 2 on one of the properties that we're closing in June, and we should have that other off-market deal under contract in the next couple of days.
Have we talked about on the podcast or on the YouTube channel how we structure the monthly emails?
No, we should. Maybe next week.
Yeah, we'll talk about that next week.
Yeah.
I think that'd be a good podcast.
Yeah, we'll talk about how to write monthly emails. I do monthly emails. That's not typical. Usually it's quarterly. I've heard some stories of operators, syndicators not even communicating until there's a refinance or something goes wrong. I do monthly, and we can talk about how to structure those monthly emails.
All right.
You good?
Good.
All right. Well, best ever listeners, I hope you enjoyed today's episode. I hope you have the best ever weekend, and we'll talk to you soon.